If you look at what's happened recently, we saw the same thing in early 16, and I remember there was running for the hills, and it turned out lower oil prices are a good thing. That's a tax cut for 90% of the world. Again, we were going through this massive, so your point about energy, Joe. And interest rates coming back down because inflation is going to come down, partly because of oil, but also because of the deflationary forces, the good deflationary forces we see associated with technology. Massive innovation taking place now that is permeating every sector and we think is really causing a lot of confusion. So oil prices going down for us is more symptomatic of electric vehicles starting to make a dent into the demand side of the equation. We think oil demand will peak in a secular sense, secularly, in the next 1 to 2 years, and then it's going down.
It's all because of it's partly because of electric vehicles?
Electric and ultimately autonomous electric vehicles, yes.
Okay.
Yes.
But when you put this in together with what you see across the commodities complex, it's not just oil. So we have a backdrop of slowing economic growth around the world. We've got aluminum prices, at 20-month lows, nickel prices at 15-month low. The industrial metals are trading off significantly, and we have oil down. Does this give you another picture, though, of just demand not being there?
Well, dollar going up is one reason for commodity prices.
Yes,
sure. Yes, the world, including China, has been slowing down. And I think what's been noteworthy but not mentioned enough is I'm a laugher disciple. So watching what China is doing on the tax front, they are cutting income tax rates pretty aggressively and cutting import duties aggressively. These are massive tax cuts. They're not just using monetary policy this time around. So we actually think, again, just like in the early 2016, it was China's stimulus that really got us back with momentum in the global economy. I think it's going to happen again.
Cathie, I'm wondering, is something changing in real time? Your bull case is very articulate, and I want to believe it. But when you see all of this volatility, you see the European banks down 50%, the U.S. banks down 25%, consumer sentiment is down, investor sentiment is down. Is it possible that you'll come back on 3 months from now and we'll say, well, it wasn't apparent in the data on December 28th, but it's been made manifest that, wow, things aren't quite as good as we hoped?
I think, well, that's always possible. But our confidence that we're going to soon be on the other side of this volatile market is increasing as inflation comes down, interest rates coming down, valuations should go up. We're at 14 times earnings. That's pretty inexpensive as long-term interest rates are coming down. So the discount factor is coming down. And I do think the China stimulus is going to surprise. I think this is very healthy. It's not just monetary policy. It's not just debt. I actually think there's going to be some very strong demand coming out of China, and that will influence the rest of Asia as well. As far as Europe and the banks, we've been staying away from Europe for quite some time. Europe has not been an engine of growth for the global economy for quite some time. So this setback, we do think banks are also in the process of being disintermediated, and they're also facing the flattening yield curve, which we don't think is a bad thing. We actually think the yield curve will invert. This is going to be very problematic for financials. And the reason it's going to invert is because inflation is going to surprise on the low side of expectations, while growth surprises on the high side of expectations, partly because of all of this innovation taking place.
I'm fascinated by the whole disintermediation storyline, Cathie, but at the same time, do you feel, is it possible that you're fast forwarding a bit in terms of the actual impact that disintermediation of the banks have in terms of transactions that happen every day? We still require the traditional banks and vehicles. Auto sales, they're down from their peaks, but they're still pretty close to their peaks. So we are seeing autos, just fossil fuel autos, still being sold.
So autos, we think, are also in the process of peaking globally, partly because, and this is going to happen sooner than I think most people anticipate, autonomous taxi networks are going to evolve. Tesla, we think, is leading the charge there, so to speak. And that means the vehicle miles traveled with electric cars, because capacity utilization of taxis is so much higher than personal cars. The vehicle miles traveled using electric cars is going to increase dramatically during the next 5 years. So many of the indicators that people use to gauge, hey, is this economy strong or not, the ground is changing underneath them because of new technologies.
Can banks be disintermediated as much as retail has been, as much as you believe cars will be, or is these threats coming later in the cycle such that they're kind of already more prepared for this than say retail was 10, 15 years ago?
I don't know. We think a company like Square, PayPal to some extent with Venmo, they're going to start taking the place of these bricks and mortar banks. And the cost of acquisition for banks, cost of customer acquisition, is anywhere from $500 to $1,500 per customer. For Square, it's $20. So their customer acquisition costs are so much lower. They have so much data on their clients, and they get it so quickly, real time. They know exactly what to do. They know when they're going to need working capital, when they're, when they should need a loan to expand their business and so forth.
What's the bull buying in this market then?
What's the bull buying?
You.
Oh, the bull buying. Oh, goodness. So the cornerstone stocks of our innovation platforms include Illumina, so DNA sequencing, Tesla, so electric vehicles and autonomous taxi networks, Teradyne, collaborative robots. We think robots are going to permeate every sector. NVIDIA has been creamed for a very silly reason, crypto. It's a short-term inventory adjustment, but NVIDIA, when it comes to artificial intelligence and autonomous vehicles, is a prime mover. And blockchain technology, we are nibbling at GBTC, which is the only financial security.
The Grayscale Bitcoin Investment Trust,
yes.
You're really describing a very deflationary environment.
Yes, very positive deflationary environment.
Well, how can it be so positive when in the last 5 to 10 years we've heard so much about the wealth effect and the importance of the wealth effect on the economy? Now we're almost reversing that wealth effect. You're seeing housing prices moderate, you're seeing asset prices moderate, and now you're describing an environment that's so deflationary, and I would think it would take looks like full employment and reverse that somewhat. How could that be positive?
So deflation associated with technology spurs unit growth. And that's what if you look at DNA sequencing in the healthcare space, DNA sequencing costs are dropping 50% per year. And that drop is causing an explosion in the demand for whole human genome sequencing. So real growth is explosive. So Illumina, expectations for revenue growth 15%. We think that's way too low. We think it's much closer to 30%. And last quarter they did have a big surprise. So what you're thinking about is a deflationary bust. We are not thinking about that. We're thinking about the opposite, a deflationary boom. And this is very hard for people to get their arms around, because you have to go back to the late 1800s, early 1900s, electricity, telephone, internal combustion engine, to see the same kind of environment. Deflationary boom, where you had an inverted yield curve more than half of the time, with short rates.
So it won't deflate the housing market, it won't deflate asset prices.
No, it's going to be very positive.